I had a long position showing about 1.6% profit, and I briefly considered trailing the stop to around 40.40. On paper, that looked disciplined. It would have locked in something, reduced discomfort, and turned an open gain into a realized one. But CPI was only about 1 hour away, and that changed the problem completely. In front of a major macro release, normal stop logic often breaks down. Liquidity can thin, spreads can widen, and price can jump through obvious levels before your order is truly executed. That is why I decided not to trail the stop. It was not stubbornness. It was a judgment about execution risk. A stop near 40.40 might have looked conservative in a calm market, but into CPI it could easily have become a poor fill. The slippage could have been around $40 per ounce, and that is not a minor detail. That is the cost of being forced to trade in a bad part of the market structure. The important point is this: good risk management is not just about reducing downside. It is about choosing the least harmful way to stay in the game. If I tightened the stop right before the release, I might have protected a modest paper gain, but I would also have increased the chance of being taken out by noise or filled far away from the intended price. That is a very different decision from a calm trailing stop in an orderly market. Trailing stops can be useful when liquidity is stable and the trend is mature. But when a high-impact event is 1 hour away, the expected cost of execution may exceed the benefit of tighter protection. The broader thesis was still intact. Oil price action remained in an uptrend, and that macro backdrop continued to support the position. So the question was not whether the market had moved around the entry. The question was whether the original trade idea had been damaged. There is a real difference between thesis invalidation and temporary volatility. A lot of traders tighten stops because they feel exposed. I understand that impulse. But feeling exposed is not the same as being wrong. Process has to come before reaction. Ask yourself 3 things: what is the chance of being stopped by noise, what is the likely slippage, and what is the cost of being wrong versus the cost of standing still? In this case, the expected cost of trailing the stop was likely higher than the value of the extra protection. So I left it alone. Not because I wanted to be brave, and not because I wanted to gamble, but because the risk-reward of changing the stop was poor. That is the real lesson. Protect capital first, but do not confuse anxiety with prudence. Use trailing stops when conditions are orderly. Avoid mechanically tightening them right before a major macro release. Estimate slippage as part of the real cost of risk management. And separate thesis damage from temporary noise. Trading is often described as a fight between greed and fear. In practice, it is a fight between process and reaction. The small, unemotional decisions are what allow compounding to survive.